Hello everyone, welcome to a new video on group accounts or holding accounts. So, from the discussion of group accounts or holding accounts, we begin our journey to the consolidated financial statement preparation. So, I'll tell you what is consolidated financial statement and its preparation and all later. But to begin with, we'll start with the concept of group accounts or what do you mean by a group? So, what is group? A group, as you all know, consists of one or more people or one or more persons. From this point of view, that is, from the group accounts point of view or from the point of view of consolidation, a group means it comprises a parent undertaking and its subsidiary undertaking. In simple terms, it means a group contains a parent company and its subsidiary company. So a parent company and a subsidiary company together constitute what we call as group. So we'll see the definition of parent company, we'll see the definition of subsidiary company towards the end of this video. So I hope you got an idea about what is a group. It just comprises of a parent company and a subsidiary company. That's all. So a parent company means that particular company has or that particular company owns more than 50% of the ordinary shares of another company. That another company is known as subsidiary company. Okay. So coming back to the concept of group accounts, let us see if one company owns more than 50% of the ordinary shares of another company, this will usually give the first company to have control over the second company. That means the parent company has a control over the second company, that is subsidiary company. Parent controls subsidiary. And the parent company has the voting power to appoint all the directors of the subsidiary company. Then, third point to note, the parent company is able to manage the subsidiary company as if subsidiary company is just a part of parent company rather than a separate entity. So when we talk about this parent company and subsidiary company, remember that both these companies have their own separate legal entity. That is, both these companies are individual entities by its own. But when they come into a group, they will have another um, point to be noted. Okay, so here the first point to notice, the parent company will have control over the second company, that is subsidiary. Second point to notice, the parent company has voting power to appoint all the directors of the subsidiary company. Third point to notice, parent company is able to manage the subsidiary company like that of a like that just of a department or maybe um, just a wing of parent company, merely a department of parent company. And the last point, but this is the most important point that you should keep in mind, in legal terms, parent company and subsidiary company remain distinct. That means they both are two individual entities who prepare their own financial statements, their individual financial statements. But in economic substance, they can be regarded as a single unit or a group. Okay, so in legal terms, parent company as well as subsidiary company has got separate existence, but in economic terms or in economic substance, they can be regarded as a single unit which is known as a group. Okay, so when we go through the annual report or when we go through the financial statements prepared by the group, for example, the parent company, we will be able to see that the parent company will have both its standalone financial statement as well as the consolidated financial statement. Standalone means the parent company's individual statement. Okay, group means it is the group financial statement comprising of the subsidiary company also. So that is the idea behind the fourth point. So these 4 points you should keep in mind when we talk about group accounts. Okay, so this is the key principle to remember. The key principle underlying group accounts is the need to reflect the economic substance of the relationship. I told you parent company and subsidiary company are distinct entities in legal terms, but when it comes to economic terms, they form a single economic entity which is known as the group. Okay, so um, coming to the single economic entity concept, what do you mean by that, or what is the purpose of that? Okay, so as you know, the main purpose of any consolidated account is to present the financial information about the parent company as well as its subsidiary undertakings as a single economic unit. So if you go through the annual reports, you will be able to identify or find out the group consolidated financial statements, or the consolidated financial statements. There you can see the information about the parent undertaking as well as the subsidiary undertaking is presented as one, as a single economic unit. Okay, then another purpose of consolidated statement is to show the economic resources controlled by the group and what are the obligations of the group. That means it can be what are the assets of the group, what are the liabilities of the group, and what is the result the group achieves with its resources. In case of profit and loss account, whether the group is making profit or whether the group is making loss. Okay, so this information can be reflected in the group financial statements. So with the concept of group, we'll now step into the concept or idea of consolidated statements, consolidated financial statement. As you know, um, every company prepares different financial statements. For example, a statement of financial position, statement of profit and loss, statement of cash flow, etc. Okay, so here when we talk about consolidated financial statement, it is the consolidation of two entities into one economic unit. Okay, or the statement of that particular group. P and S forms a group, parent and subsidiary. It forms a group, and the financial statement of that particular group is known as consolidated financial statement. If it is balance sheet, we'll call it as consolidated statement of financial position. If it is a P&L account, we'll call it as consolidated statement of profit and loss. So that is the idea behind consolidated financial statements. Okay. So to talk about the consolidated financial statement, we'll just start with the basics or the basic idea behind consolidated financial statement now. Okay, so the consolidated financial statements always provide a true and fair view of an organization's financial health across all divisions and subsidiaries. That is the main aim or the main purpose or main objective of consolidated financial statements. Okay, so in simple terms, consolidation is bringing together under the umbrella of a parent company the financial statements of all its subsidiary companies. Parent company act as an umbrella under which all the subsidiary companies come. It just means combining all group financials and integrating them into a single source for reporting purposes. Okay, so you will come across what are the different concepts to be considered while preparing the consolidated financial statements when we start with the preparation. Okay, so just keep in mind the overall purpose of consolidated financial statements is to provide a true and fair view of the company's overall position for the financial year. Okay, so now coming to the preparation of a consolidated financial statement, just the basic ideas behind the preparation. There are four Ind AS that are relevant to the preparation of consolidated financial statements, um, of which Ind AS 110 will be discussed in detail for our purpose. Okay, but there are just keep in mind there are four Ind AS that are relevant to the preparation of consolidated financial statements, namely Ind AS 103, that is business combinations, Ind AS 110, that is consolidated financial statements, Ind AS 28, investments in associates and joint ventures, and Ind AS 112 disclosure of interest in other entities. So among these four, for our purpose, we will see in detail Ind AS 110 through our videos, and the other three I think you have already discussed or you have already went through or you will be in the future. Okay. Yes. So as I told you, coming to the definition of parent, subsidiary and control. So according to Ind AS 110 consolidated financial statements, it uses the following definitions for parent, subsidiary and control. So who is a parent company? It is an entity that controls one or more entities. Very simple. And who is a subsidiary company? The entity which is controlled by another entity which is known as parent company. Then what do you mean by control of an investee? So control means, what is control? So the first um, line of our discussion was regarding more than 50% of control. So what is this control? An investor controls an investee when the investor is exposed or has the rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. So when a particular parent company has the right to the variable returns from that particular investee, or the parent company has the ability to affect that particular returns, then we'll call it as control. That is the meaning or definition of control according to Ind AS 110 consolidated financial statements. Okay, so now we'll talk about certain exemptions for the parent company from the preparation of group financial statements. Why? Or what are the exemptions? So, a parent company need not present the consolidated financial statements if the four following situations arise. Let's see one by one. The first situation is the parent itself is a wholly owned subsidiary or a partially owned subsidiary, and its owners, including those not otherwise entitled to vote, have been informed about and do not object to the parent not preparing consolidated financial statements. That means, just keep in mind, we have a parent company known as P, its subsidiary company known as S. But the parent company itself is a subsidiary of another company which is known as Q, for example. So we have three companies, Q, P, and S. Okay, so S is the subsidiary of P, P is the subsidiary of Q. So when the parent itself is a wholly owned subsidiary, this exemption can be applied. That is the first point. I hope you got the point. Okay. The second point is the parent company's debtor equity instruments are not traded in a public market. If it is not happening, then they need not present the consolidated financial statements. Okay, that's clear, I think. Then third point is the parent did not file its financial statements with a Securities Commission or other regulatory organization for the purpose of issuing any class of instruments in a public market. So, in order to issue any class of instruments or any type of instruments in a public market, it has got its own regulatory formalities. Okay, so if the parent company did not file its financial statement with the Securities Commission or whichever the regulatory organization, then this exemption stands. And the last exemption is the ultimate parent company produces consolidated financial statements that comply with accounting standards and are available for public use. So if the ultimate parent company, for example, if Q, P and S, we have three companies, same example. Q is the ultimate parent company. If Q produces consolidated financial statements complying with the accounting standards and are available for the public use. In this point of time also, this particular exemption stands for the parent company. So these are the these are very few exemptions. We have more exemptions, but these are very few exemptions to keep in mind regarding the preparation of group financial statements. Okay, I hope that's clear. So now coming to the principles, and later we'll discuss about the method of preparing consolidated financial statements towards the end of this video. So the basic principle of a consolidated statement of financial position. We are starting with financial position. That is, in simple terms, we'll call it as balance sheet. Okay. So through our videos, we'll begin with the preparation of consolidated statement of financial position, the procedures, and we'll solve a few problems. And then we'll step into consolidated statement of profit and loss. Okay. So what is the principle of consolidated statement of financial position? So the basic principle is the consolidated statement of financial position shows all assets and liabilities of the subsidiary and the parent company. Okay, all the assets and liabilities of parent and subsidiary. But there are certain adjustments that we learn. So just keep in mind It this consolidated statement of financial position must have all the assets and liabilities of the parent and subsidiary company. Okay, but certain items are excluded, like intra-group items. Okay, that is any transactions or any happenings between the parent and subsidiary company that needs to be excluded in the consolidated statement of financial position. We'll see that also. Okay, so this is the basic principle behind this. So now we'll see the method or procedures for the preparation of consolidated statement of financial position. So the step one of the procedure is adding together the like items. Adding together the like items of parent and subsidiary company financial statements except equity and investment elements. So, except for equity, that is share capital, maybe share premium, reserves, except for that and investment elements. For example, investment in associate, investment in subsidiary. Except for these two items, all the other like items of the parent company and the subsidiary company will be added together. That is the first procedure or maybe first step to keep in mind. Okay. Don't worry about this. We'll see this in detail when we come to solving problems. Then, second step is the cancellation or part cancellation. So now the question arises, cancelling what? So cancellation means the cost of investment in subsidiary is cancelled with the parent's portion of equity elements of subsidiaries. Don't worry about any adjustments. Okay, it gets cancelled automatically. We'll see when we come to the question. So just keep in mind there is a cancellation of the cost of investment in subsidiary that is cancelled with the parent's portion of equity elements. That means maybe for example the question will be like this. Parent company controls 80% of the subsidiary company. That means 80% of the share capital of subsidiary company is controlled and owned by the parent company, right? So that is related to the step 2. The cost of investment in subsidiary will be cancelled with the parent's portion of equity elements. We'll see that. Don't worry. Then step 3, recording of goodwill. So we have a working note for the recording of goodwill. So how goodwill is to be calculated. Okay. And after calculation, we'll record goodwill. Then in step 4, group share capital. That means share capital will be considered only for the parent company. Only parent company's share capital and other components of equity will be considered or recorded in the group financial statement. Okay, that is group balance sheet. Then step 5, group retained earnings. So we have a working note to see how group retained earnings are calculated. Just for now, understand the parent company's retained earnings plus the parent company's proportionate share in post acquisition profit. We'll discuss that in later. And step 6 is non-controlling interest. Okay, so non-controlling interest means the portion of subsidiaries share which is not acquired by the parent. So in the previous example I told you, parent company, that is P, owns and controls 80% of the subsidiary company. So 80% is owned by the parent company and the remaining 20% is considered to be non-controlling interest or NCI. Okay, another example, parent company controls 60% of subsidiary company. What is the NCI? 60% is controlled by the parent company and the remaining 40% will be considered as NCI or non-controlling interest. Okay, so the portion of subsidiaries share capital which is not acquired by the parent is known as non-controlling interest. And now step 7, the elimination of intra-group balance, transactions and unrealized profit or loss, that we'll see when we come to the calculation. Okay, so both the parent and the subsidiary company are treated as one and intra-group balances are eliminated or intra-group transactions are eliminated in the case of consolidated statement of financial position. Okay. So I hope by now you got an idea about what is a group, what is parent, what is subsidiary, what is NCI, what is control, then what is consolidated financial statement, and to begin with, consolidated statement of financial position, what is its purpose, and the beginning procedures for that. Okay, so in the next video we'll see what are the working notes and how each item like goodwill, retained earnings, each item is to be calculated and recorded in the statement of consolidated statement of financial position. Thank you.